Warren Buffett just bought a $4.3 billion stake in a mega-cap tech company, his biggest new position since 2022, and it has already become one of Berkshire's top 10 holdings. It is the exact company Buffett openly said he missed the chance to invest in back in 2017. Yet now, after the stock has climbed by more than fivefold and is trading near all-time highs, he's finally buying in. The stock is Alphabet, the parent company of Google, and that timing alone splits opinions. Some see it as a signal to follow, while others think he may be late to the move. At first glance, Alphabet isn't the kind of business Buffett usually touches. For decades, he avoided most technology stocks, saying that they sat outside his circle of competence. He preferred companies he understood deeply, like insurance, banks, and classic consumer brands. Even Apple, which became his largest holding, he treated as a consumer goods company, not a tech bet. And his biggest wins typically came from buying undervalued companies or stepping in during moments of market panic, like when he bought Coca-Cola during the market downturn in the 1990s. And troubled Goldman Sachs stock during the 2008 financial crisis. Those kinds of moves helped him generate billions and turned Berkshire into one of the most successful investment firms in the world. Alphabet, on the other hand, doesn't resemble any of those opportunities. The stock has more than doubled just in the last 6 months, and it's still hovering at all-time highs. And from a valuation lens, Alphabet currently trades around 25 times earnings, higher than the S&P 500, which sits closer to 20 times. And it's far above what Buffett typically likes to pay. When he bought Coca-Cola, it was around 14 times earnings, and Goldman Sachs was around 12 times. Even when compared to its own history, it's not exactly sitting at a discount either. At 25 times, the PE ratio sits around the upper end of its typical range, so Alphabet isn't cheap. At best, you could call it fairly valued, which is why many people see this move as Buffett bending his old value investing rules. But to understand Buffett's decision, we need to look at Alphabet the way he would, starting with the underlying business and not the stock price and valuation. One of the first things that stands out is how much cash Alphabet generates. Over the past 3 years, Alphabet has held an average cash pile of about $105 billion, the highest among the entire Magnificent Seven. And instead of letting that cash sit idle, Alphabet returns a significant portion of it to shareholders through massive buybacks, which have climbed from almost nothing in 2016 to roughly $13 billion in this quarter alone. And this is exactly the kind of behavior Buffett likes. Buybacks reduce the number of shares, which automatically boosts earnings per share and increases the ownership stake of long-term shareholders like him. So Buffett isn't suddenly chasing tech hype. He's buying a cash-generating machine. If we break down where that cash actually comes from, one thing dominates the picture. Nearly 60% of Alphabet's revenue comes from Google search advertising. This is where Google sells ad placements to businesses across the world. And it dominates because billions of people rely on Google as their primary gateway to the internet. And that dominance shows up clearly in the numbers. Over the past 15 years, Alphabet's revenue has climbed from around $20 billion to more than $400 billion today, all while barely slowing down even during recessions. However, for the first time in nearly 20 years, Google's core search business is facing real competition. Some analysts warn that AI-powered search tools like ChatGPT or Perplexity could chip away at Google's dominance. Instead of searching on Google, users can simply ask an AI model and get the answer instantly, and that could mean pressure on Google's ad revenue. So Buffett here is buying a business that's facing a potential structural shift in its largest revenue source. And this risk is perhaps why the market prices Google more conservatively than other mega-cap tech names. Nvidia, for example, trades near 40 times earnings. Apple is around 33 times, and not to mention Tesla that sits above 200 times, all while Alphabet trades at around 25 times. Buffett is most likely aware of these risks, but when we look at the broader picture, even after 3 years of ChatGPT release, Google still reaches almost 5 billion people every month, while ChatGPT sits near 500 million, and it still controls close to 90% of global search engine market share. Alphabet has also been using its massive cash pile to aggressively build its own AI systems and merge them into search. And beyond search, Alphabet still owns category leaders. YouTube dominates global video streaming, and Android powers nearly 70% of the world's smartphones. Together, they form the kind of economic moat Buffett has praised for decades, a position so strong that rivals struggle to break through. His move suggests that he believes Google's user scale, data advantage, cash reserves, and ecosystem give it the best chance of defending and potentially strengthening its position in the AI era. And the market's concerns around AI may be exactly what's keeping the valuation at a fair price for him. It all echoes a philosophy he learned from his late partner Charlie Munger. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And whether this becomes another big win for Berkshire or a rare Buffett misstep depends on one thing: whether Google can keep its dominance in the AI era. At Capital.com, we'll keep tracking how the world's top investors like Warren Buffett, Bill Ackman, and Michael Burry are positioning themselves in this rapidly changing market. Hit like and subscribe to stay tuned. Thanks for watching.